Good morning to everybody, and welcome back to Boutiques on Wednesdays. It does seem that we have some connectivity issues this morning. I don't know if it's about because of all the flooding going on in some parts of the country, or fires in other parts of the country, or just bandwidth being taken up by people commenting on street name changes again. Right, but we're not going to deal with all that silliness today. From the BCI team side, thank you so much for joining us this morning, your continued support and your time. We have a wonderful session for you today, covering just about everything from bonds, credit, global, local equities, and asset allocation views as expressed in the Aluwani BCI Flexible Income Fund and the Aluwani BCI Balanced Fund. Have you ever heard of a fixed income investment clock, or how it works? Right, some of the stuff we're going to look at today. It is my absolute pleasure to welcome two of the founding members from Aluwani Capital, Head of Fixed Income Strategies Conrad Wood, and Head of Equities and Multi-Asset Strategies Patrick Matidi. Conrad and Patrick, thank you so much for joining us this morning. We hope the lines stay stable, but we'll see how it goes. How are you this morning?
All good this side, Eugene?
All good, thank you. Fantastic. Well, the sound is clear. I can see you fine. Nothing is freezing up. Conrad, you off to go. If you're ready, you can start.
Excellent. Thank you, Eugene. Good morning, everyone. Thank you for making the time to meet with us this morning. Thank you to BCI for the opportunity. So, as Eugene has kind of alluded to, the world is in a very uncertain place with lots of massive event risks and lots of big macro events that are occurring in a almost a counterintuitive way to what you would expect them to do in the current investment backdrop. And so we thought we'd try and unpack a little bit of that backdrop this morning and look at it through the lens of two of our unit trust portfolios, and that is the one that I'll cover, the BCI, or the Aluwani BCI Flexible Income Fund, and then my colleague Patrick will take us through the Aluwani Balanced Fund. So if we get right into it, I'll just give you a very brief update on Aluwani. So believe it or not, we're approaching 8 years old at the end of this year. So we're well into our path of creating a large multi-strategy investment management business, one that is majority Black owned, but importantly owner controlled and managed, one where the staff have significant participation in the ownership structure, thus aligning our objectives with clients, and one that is sustainable and mutually beneficial to all stakeholders. So we've made our way to 121 billion rand of assets under management. We've expanded our geographic footprint into some of the SADC countries, in addition to our presence in Johannesburg and Cape Town. And we are fighting the good fight in a market and an environment that is extremely competitive and extremely tough in which to run an asset management company. So enough of that. Let's get into the Aluwani BCI Flexible Income portfolio. And this portfolio seeks to capture all of our best fixed income ideas in one fund. So you can see on the Venn diagram on the left there, asset classes like nominal bonds, inflation-linked bonds, money market assets, credit assets, currency, not on here, listed property, and some other fixed income asset classes. We're looking for that intersection set in the middle, that optimal positioning in the fund where we can capture both growth from our asset allocation decision, but also high income or running yield in the portfolio that gives investors that sense of stability that they expect from fixed income portfolios. The table on the right just gives you an idea of the risk framework within which we manage this portfolio. So this portfolio is targeting STEFI or money market plus 2%. So that's the upside potential or prospect, but it's not without downside or risk mitigant targets, if you like. And there we have a maximum annualized volatility of 2.5%. We target no negative quarter, and we target no annual underperformance of STEFI. So you can see a healthy blend of both an upside target, but also capital protection or downside risk management. And so if we look at a multi-asset fixed income portfolio at this stage of the cycle, we like to revert to our fixed income investment clock or a compass, for a guide, almost keeping us on the straight and narrow. And if you look at this investment clock, and it simply works in a clockwise fashion, you'll see at the top is inflation peaking, at the bottom is inflation troughing, and then in the right-hand quadrants you have rate cuts, in the left-hand quadrants you have rate hikes. And we believe that we're somewhere, all else equal, we're somewhere in the top right-hand quadrant where inflation has peaked, it's coming down. The rate hiking cycle has likely peaked or is very close to peaking, and rate cuts become a probability at some stage in the future. At a best guess, that looks like, something like the middle of next year at this stage. And generally, the point I'm trying to make, that anchor or that guide for us is in that top right-hand quadrant. You're generally building up risk to fixed income asset classes. Those quadrants are colored in green for a reason. It's cyclical. It's a go for fixed income. Performance is normally strong for these fixed income asset classes, as opposed to the quadrants on the left-hand side where fixed income asset classes are under pressure due to rising inflation and rate hikes. So in this quadrant, and indeed in the bottom quadrant as well, you would expect to see funds long duration, adding bond exposure, adding credit exposure, adding listed property exposure, and down weighting the likes of inflation-linked bonds, your foreign currency exposure, and cash, your more defensive asset classes, down weighted in favor of your more cyclical asset classes. Now, accompanied by this macro clock or sector of the clock where it's a go for fixed income assets, are also what appear to be great valuations. And you'll notice I put a question mark behind the statement great value. These three charts, by historical standards, would suggest that bond yields are really well priced, keenly priced at very high levels. So the top left-hand chart shows you that in the South African 10-year bond, you are getting as much as 6.5% above inflation, and on forward-looking inflation as well. And that's probably, or certainly on this chart, which goes back to the global financial crisis, the highest it's been. On the bottom left-hand chart, you can see that you get around 7.5% above US Treasury yields as a risk premium, as an enticement for foreign investors. And you'll see, while that's not at the highs, it certainly is at the pre-COVID highs. And then just lastly, on the right-hand side, you can see the bond yield relative to the 3-month money market rate. And that's also elevated at greater than 3% pickup that you are earning by being in bonds instead of cash. And so we go, well, the macro clock says the environment is primed for bonds and cyclical fixed income asset classes to outperform. Valuations look pretty decent, certainly on an historical basis. But we're sitting in an environment where bonds and other fixed income asset classes linked to bond yields, listed property, ILBs, credit, are all underperforming in general. And you can see this chart shows you annual calendar returns for the all bond index. And you can see how that's fallen off dramatically from the peaks in 2016. It's come lower and lower and lower each year, where for the last 2 years, you're earning very low single-digit total returns from the ALB on a calendar basis, where your starting yields were actually 11.5%, and you're coming away with total returns of 3, 4, 5%. So that is very counterintuitive relative to what I've just described to you should be somewhat of an ideal environment for bonds and other fixed income asset classes to outperform money market. And so this is where we get to this idea that we're in a very uncertain environment, and there's a few things that are happening that suggest that the traditional macro cycle and the traditional behavior and correlation of fixed income asset classes are a little bit upside down, turned on their head at the moment. And I'm simply going to look at three of the big picture themes that are causing this uncertainty. And we'll start with the US, a market that is at front and center, whether we like it or not, despite all the talk about de-dollarization and that the US is no longer risk-free, etc. It's at the center of valuation for global asset classes, and what's happening there continues to drive what's happening in global markets. And if we look at this market, our view certainly is that the decent growth over the last few years, the decent performance from asset markets in the US has been largely fueled by money creation and debt. If you look at the real sort of economic variables, things like trend growth, things like productivity in the US, they are all falling. And there is a underpin to these markets and that growth and that economy that is coming from government spend, government debt, and money creation. And the chart on the left shows you the increase in US national debt over the last 5 years. And it has made its way from an alarming 21 trillion 5 years ago, almost vertically, a 53% rise over the last 5 years, and US national debt sits at $33 trillion. And I enjoy the chart on the bottom right there that shows you US interest payments per day to service their debt have doubled from $1 billion per day to $2 billion per day in 2023. And that's before this wall of debt that needs to be refinanced at higher yields becomes due in the next 12 to 18 months, which is going to put even more pressure on these debt metrics. And so the US is dealing with a massive rise in debt, a massive rise in debt service costs, a massive rise in borrowing requirements, in issuance of bonds, and essentially the unwinding of all the excesses that were in the US bond market over the last decade, since we were introduced to the concept of quantitative easing, money printing, and US bond ownership by themselves, essentially, the Fed buying up half of US issued debt. Anyone sort of the term Ponzi scheme come to mind. And so it's no surprise that the unwinding of these excesses that have been as extreme as anything that we've seen almost ever in the US bond market has caused massive drawdowns in total returns from US bonds. The left-hand chart shows you the Bloomberg US Aggregate Bond Index on a rolling 4-year basis. And why 4 years is because that's the period that we've experienced negative returns over in total returns in the US bond market over the last 4 years. So the last 4 years has seen the first ever total return drawdown in the US bond market in the last 50 years. US bonds delivering -7% on a rolling 4-year basis to the end of August. And the table on the right just drills a little bit further into that, and you can see that the current period of drawdowns in that US bond market started 37 months ago, which dwarfs anything else in terms of a drawdown period.
Conrad?
Yes, Eugene.
Conrad, sorry to interrupt. Some of your sound is getting lost, so I can hear most of what you're saying, but maybe try killing your video. I think it should improve the sound as well. Let's try that. Sorry to interrupt you.
Not at all. Important that you guys can hear. I'm trying to do that and going into freeze mode. Maybe it'll take a while for it to come through. Can you hear me, Eugene?
I've got your sound. That's better. Thank you.
Okay, let's try. Please interrupt if it's not going well. And you can just see the extent of the drawdowns in the US bond market and the length of time that this is happening over. Guys, this is a repricing of significant proportion in US bond market. And the surprise for me is not that it's repricing. The surprise for me is how well everything is holding up in the face of a substantial repricing of one of the largest asset markets in the world. So that's the US, over-indebted, have printed themselves to prosperity. They're now suffering the consequences. There's an unwind of significant proportions going on there. US bond yields should not be going up like they are with the current level of inflation and moderate growth in that economy. Nevertheless, they are rising quite substantially. The second big picture theme is China, and China seems to have entered into the triple D spiral, as we call it. So debt, deflation, and demographics, which is a miserable place to be. Think Japan, sort of two decades ago. And we're all familiar with these challenges. You can see the left-hand chart shows you that the problems in the Chinese property market caused by overcapacity, leverage, lack of affordability, you name it, and you can see the collapse in new sales and new starts as consumer confidence, business confidence plummets there, and as the excess inventory crowds out that property market. On the right-hand side, you'll see that for the first time almost ever, that the death rate is at the same level as the birth rate in China. So we know there are challenges of the one-child policy, of the aging population, and this alarming compression between birth and death rates. And the famous saying goes that China will get old before it gets rich. At the same time, global trade dynamics are shifting materially, and we're familiar with the whole onshoring and friendshoring and nearshoring. So let me as a country be sovereignly in control of my manufacturing capability, my sourcing of my commodities, the sourcing of my inputs that I need to take care of my needs. Let that be with either friendly trading partners or let me do it myself. Case in point was the over-reliance of Germany on Russian natural gas, and that has caused a mini implosion in the German economy. So you can see this chart shows you also for the first time in a very long time that the US is now importing more from Mexico than China for the first time in the last 2 decades, as global trade dynamics shift and change in this fluid environment. And what do we make of this decline in China? This is a very interesting chart that just shows the alarming fall off in the publication of Chinese economic data. At its peak, and just before Xi became leader, China used to publish 80,000 economic variables per annum into the public domain. And you can just see how that's fallen off and declined alarmingly to where they are very clandestine about data and very sort of non-public about data on that economy. And I think this is symptomatic of a country that's become a lot more inward-looking, a lot more focused on security, a lot more embroiled in this global sort of tech and geopolitical Cold War that extricated themselves from a lot of the trade, global trade and supply chains, and are focused on security and their own sort of internal well-being rather than an external model based on growth and manufacturing. And this is one of the symptoms of how they like to operate. And the third pillar, guys, just moving on then, so you've got an alarming rise in US bond yields, an alarming fall in Chinese growth and inflation. That double whammy is awful for emerging market assets. And as I've said earlier, the only surprise to me is that emerging markets are not underperforming more than they are. And then you chuck South Africa into the mix with its fairly depressing state of local fundamentals, which is a very low growth economy and rapidly increasing twin deficits. And you can see why we have our struggles here. So twin deficits, your budget deficit, plus your current account deficit. So your budget deficit, government's overdraft, the difference between spending and revenue on the sovereign side. Current account deficit, the difference between exports and imports on our net trade side. Government deficit, 200 billion odd rand at the moment, will likely end the fiscal year at about 350 billion odd rand. the current account deficit is deteriorating quite dramatically as commodity prices fall. And soon you will have these adding up to close to 10% of GDP, which is one of the worst twin deficits in emerging markets. And indeed is the kind of level that sparked the debates about the fragile five emerging market economies some years ago. And this is at the same time that one of our large and substantial funders, the so-called foreign bond investor, has left the country's bond markets in droves. And you can see the blue line there is foreign bond holdings, which peaked over 40% of our total bond market was owned by foreigners. It's now down to around 25%. And that just very loosely implies an exit of around 700 billion rand of foreign bond investor money. And that roughly equates to 2 years of budget deficit, as I've just shown you on the previous graph. So in an environment where the US yields are high and offering 5%, and China is deflating and causing a lot of interest for the global markets, foreign investors will be skittish at best. And when you have an economy that is putting the current set of fundamentals in front of them, that South Africa is, they probably have better places to park their cash. Certainly on a tactical basis, we need to hope not on a strategic basis as well. So just to land this quickly, looking at the flexible income fund portfolio positioning, then we have quite a strong conservative bias. So in opposition to that macro cycle that says fixed income assets should start doing well, in opposition to the elevated level of bond yields and listed property yields and inflation bond yields, we still think this combination of the US, China, and South Africa specific risks pose a significant problem for domestic fixed income markets and the rand. And so we find the risk-free cash return of 9% from local money markets very appealing right now in a flexible income fund. We have quite low duration or low bond exposure, sitting at only 1.2 in a fund that could go up to 3 in modified duration, and compared to an all bond index, for example, that's sitting at 5 or 6. We think that the yield curve is prone to steepen given our fiscal concerns, and so the bonds that we do hold are short and medium dated. We like inflation-linked bonds, despite that macro clock and that macro environment saying they're defensive, we don't need them at this stage of the cycle as inflation is falling. We think inflation risk still remains high, and the real yields on offer from inflation-linked bonds are appealing. Listed property is not an asset, in our view, that you want when global equity markets are vulnerable to a substantial pullback and domestic bond yields are rising. So we have zero weighting there. We have foreign currency exposure in the portfolio because despite the rand, despite the rand being undervalued or oversold, in our view, it continues to be under pressure in this environment. And lastly, we are very selectively in this macro environment seeing good credit opportunities, particularly in private credit markets. And so the Aluwani fund it continues to do fairly well. You can see the graph on the left-hand side since inception, which is now about 2 3/4 years. It has comfortably beaten its cash plus 2 target on both the gross and a net basis. Over the last year, slightly lagging the cash plus 2 target in what, as I've said, has been a very difficult year for fixed income asset classes, but still delivering a healthy almost 9% total return on a net basis. And I think the chart on the right says it all about these flexible income funds. You want them to, with lower volatility, outperform your fixed income asset classes, that cash plus 2 target, and inflation as well. And you can see the orange line there, our fund over its inception period, doing that quite nicely, and particularly in this environment, just rising a little bit more steeply than the other asset classes which are struggling, largely due to our conservative stance. Guys, I'm going to stop there and hand over to Patrick to take you through the balanced fund. Thank you.
Thanks, Conrad. Good morning, everyone, and thanks once again for the opportunity. So I'll try and keep my video on, but should I break or be inaudible, please do alert me and then I'll switch it off. So the environment that Conrad has painted, I think for us is that of a shift away from, I guess, the era of abundance or access, as evidenced by low interest rates, a lot of cash coming through the system. That shift going into what we would call an era of scarcity, as evidenced by high interest rates, high inflation for longer, and obviously the need to pull back, in the form of stimulus as things are sort of normalizing to some extent. And that transition will be painful, as they always are. And we believe as a team that it actually favors multi-asset portfolios. So Conrad took you through the income fund, the flexible income fund, and it is my duty to take you through our multi-asset portfolio or the balance fund. So we've been in this space on the BCI platform for the last 2+ years or so. I haven't cut our teeth, I suppose, in the institutional space where we do have quite a longish tenure. For us, the way we approach multi-asset portfolios or the balance funds is they tend to have an inflation plus target as a performance target. In this case, it's inflation plus 5 over any 3 to 5 year period. And how we build them or put them together, we take a lot of guidance from regulation, in this case, Reg 28. As I said earlier, the product is also available on the institutional side. So regulatory wise, we have the 55-45 split in terms of what we can invest domestically versus global. And then we build a product using your traditional asset classes. Within there also, you've got different sectors, and obviously you have instruments that you can pick within those asset classes. And the weights, the column in the middle, this is what we would call our strategic asset allocation. So if all else goes well in terms of us trying to target that CPI plus 5, and given how these asset classes have behaved, we believe that combination of asset classes in the form of weights, should lead us to that CPI plus 5 for target. Again, all else being equal, and that also being based on a long run returns and volatilities of those asset classes. Clearly, the world is not as linear. So as and when we ebb and flow and looking forward, we do find opportunities where we are therefore able to tilt away from those weights and have a slightly different weighting, which I'll share with you also in the last couple of slides in terms of our near-term views on those asset classes, which then informs our tactical asset allocation and hence those tilts away from our strategic asset allocation weights. And then, as I said, if we do a decent job for each and every asset class, given our weights and given our positioning of a tactical asset class positioning, and also the stocks that we pick within those domestic, within those asset classes, we think that we can generate alpha. If you look at those targets on the second last column on the right-hand side. So again, it's a function of being correct with our asset allocation, but also being correct in terms of what we see coming through of a tactical view, and obviously picking the right stocks within those different buckets. And the way we run this portfolio is of I guess what we call a building block approach. So I try not to be an all man to everything. So I rely quite heavily on the different teams that service myself. So on the fixed income side, it's Conrad and his team. So there we rely on the team in terms of where to be positioned, either from an ORBI point of view or within the cash bucket, which is also where the guys actually add quite a lot of value, given what he has presented earlier on. And then I'll share with you on the global side, where we are very excited to introduce a team that we've been working on the FT side over the last while, that actually aims to give us that flexibility and that extra lever in terms of opportunities, a lot of which are not readily available for South African investors, but we believe that going forward, it is absolutely key to have that ability to can diversify your risk away, and not only geographically, but also from a correlation point of view. And therefore for us, that global element becomes very key. So if you can move to the next slide, Conrad. So on the global side, as I said, we should be launching a pure play or focused global equity portfolio in the next, not so distant future. Still offer this platform, so be on the lookout for that. And then the way we intend running that portfolio is with the assistance of this team. So we signed up an agreement with Franklin Templeton, one of the largest asset managers globally. And for us, it was key to have an access to one of the best, largely because not only are we seeing a lot of demand from our clients domestically, but for us to have credibility and be able to offer a decent job for our clients. It's actually important that we do that with a team that has been there, good years of track record and outperformance in a market that they are a lot more familiar with, as opposed to some of us sitting here in Johannesburg. So this team for us, ticks all our boxes, from a philosophy and a process point of view. If you read some of their writings and some of their blurbs, it almost feels like an Aluwani of sorts. So for us, then it was very exciting to actually meet a team who actually looks at the world, from the same lens as us. I have got different, sort of same philosophies and a slightly different process, which clearly is right for purpose when you look at the global world, but for us actually resonates in terms of what we would actually look for in the different stocks. So as I said earlier, this team will then fit into our offshore product from a building block point of view, and the idea is to work with them very closely from a stock selection point of view, where they would then do the deep dive research. They will present to the combined team such that whatever ends up in our domestic, in our global balance fund, our multi-asset fund, it will be products that we know, stocks that we know, that we have got first-hand experience from a research point of view. So it almost feels almost like an Aluwani sitting inside our team, but based offshore. Next slide, Conrad. So just to give you a sense of how we are positioned, where we are finding opportunities. So this is the full-on portfolio with the different building blocks. So anything above the line, we're overweight. Anything below the line, we're underweight. So you can see optically that the big two positions are inflation linkers. So where we are max underweight. And that's largely given the view, especially as painted by Conrad and his team, that if you look at the inflation premium that is implied in ILBs, it's actually not, it's very expensive. It implies almost a worst case outcome for inflation. So that premium that you're paying for that inflation risk in our mind is not well justified. I would believe that there is better value to be had in nominal bonds, and hence us being overweight on the nominal side. And then if you look at from left to right, you can see cash are almost flat. There, as Conrad mentioned, we're picking up about 9% yield, which is okay, for this product, especially when you are looking at an inflation of CPI plus 5. So cash at 9%, you are getting a real sort of a return of cash. But clearly, we are anticipating that should come off as and when we start to see rates sort of coming off. On the SA equity side, small overweight. So the case for SA equities is very, very tricky in the sense that we do see value. So for us on the domestic equity side, it's not a valuation issue. There's plenty of value to be had, but the big key question is around the E, or the earnings, right? So where's the earnings going to come from? And so you do run a risk of being too early and being caught in value traps, where the companies are okay, they're doing well, but the earnings are not actually coming there. And that then speaks to the broader macros in an environment where you need to see proper growth coming through for the companies to actually do well. I think the SA corporates have done a sterling job, especially post-COVID, where we have seen a very little growth, but we have seen decent earnings coming through. A lot of it is not really top-line growth, as in a growth in sales or revenue, but also a very tight cost management that they've managed to actually pull through. And the risk, therefore, remains that if the top line is not growing, there's only so much cost that you can take out of the system, and then you can only grab so much market share from competitors. At some point, you do need the quick to actually grow and grow meaningfully for there to be a significant re-rating on some of the stocks that we do have. But I'll share with you where we are positioned in terms of stock picks, where we are seeing value despite the fairly unexciting macro picture that we're currently experiencing. On the domestics, on the property side, sorry, Conrad, just to go back one. On the property side, not a massive positioning. So there we only have one stock that we like, that is NAPI. That is largely because of its own pure play fundamentals, but also it's a bit of a nice hedge against the rand, given the offshore exposure. On the SA property stocks themselves, we are still a bit wary. One, from a top-down point of view, as Conrad mentioned, you don't want to be massively into property where you are seeing better value in bonds from a yield point of view. But also, we don't like the SA property fundamentals, especially office and retail, largely because I think if you look at some of the drivers, you've got massive vacancies still. The guys are still struggling with rental revisions. The cost line is still running way ahead of the top line, and also against running way ahead of national inflation. So we think that the fundamentals for the asset property sector are still fairly much constrained. And once again, you need massive growth from an economy point of view, for some of those levers to actually start to subside, and for that value that we are seeing to start to be realized. So again, there is value, but again, for us, it's largely a function of how that value will be realized, given the macro picture that is still fairly challenging. On the bond side, we like the bonds. We still think that the pickup in terms of yield, is still fairly attractive, especially when you are chasing inflation +5. However, there are risks, and I think Conrad did paint some of them, especially on the fiscal side, where, depending on how that plays out, that can also be a bit of a headwind, despite the yields that we are seeing. So you could still have such a high yields going forward, but we do think that on a risk reward point of view, it's probably better to be in asset bonds as opposed to, let's say, asset equities or even global bonds for that matter. And then on the global equity side, that's where we are seeing quite a bit of value. And then there for us, it's around what the team is showing us, which we like. It is stocks and sectors that are uncorrelated to our market, where we do not have similar stocks or a similar exposure, and also offering a lot of value, which is obviously one of our key tenets when you look at stocks, that is that being valuation. Then the next slide, Conrad. I think this is almost a derivative of the previous slide, just to give you a sense in absolute terms of the portfolio is positioned. So you can see that we've got quite a bit of cash, a lot less property, a lot of equity, both SA and global. And then you can see this second largest sector being SA bonds. And then on the global bond side, we do have some, but we remain underweight. And I think in finance, we probably were a little bit earlier in getting into global bonds, on the premise of, I guess inflation haven't peaked and the first rate cuts coming through. But as it turns out, perhaps we have been a bit early on that front, but still comfortable to be positioned this way overall. Next slide. I guess in conclusion, I think for us, as I said in my intro, this environment that we are going through, this shift away from abundance, into scarcity, it still favors multi-asset portfolios, largely because you get nice diversification from an asset class point of view, sector point of view, and also geographics. We think diversification is probably one of the underutilized levers in any portfolio. And also we want to have ideas in the portfolio that are low correlated, given how the markets have tended to behave of late, where you still have quite a lot of correlation coming through, especially on your traditional asset classes. On the traditional side, I touched a little bit on it. For us, the key thematic, if you look at our domestic equity carve-out, is that of quality and then growth at a reasonable price. Right? So we do like quality companies. We think this environment actually favors businesses that are highly cash generative, businesses that have got very low debt, especially given the high interest rates that we're going through, businesses that have an ability to convert a lot of the earnings into free cash. I would like those kind of businesses. And clearly, if they are well priced, and certainly we are happy to actually pile onto them. And there, we've got businesses like your True Wealth on the retail side, Mr. Price. Now we think that they fit into that framework. And then obviously the banks, the banks, yes, they are boring, yes, they are overowned, but they are unlikely to hurt you, and they are offering a lot of value. You've got things like ABSA that is trading at a lower PE than its dividend yield, right? And that dividend, in our mind, it is secure. It will come through. So why not? Especially when you are chasing inflation plus. And then on the global side, the team is showing us quite nice ideas where, as I said, I keep saying, we do not have access to those on the JSE side. So you get a nice a diversifier. We are seeing a lot of AI-based businesses that are actually coming through. And yes, AI has done very well, especially if you look at the NASDAQ year-to-date basis. But there are other sectors downstream in terms of the value cycle that are actually coming through on the specialist healthcare side. For example, businesses that are doing a lot of good work given the aging population and dynamics. Semiconductors, I think you all know of NVIDIA that has done well year to date, but there are other players in there that continue to benefit from this innovation that is being driven by AI. And one can't help but also mention sort of your future commodities that are driving this greening revolution, which in our mind has to happen, just given how precarious the world is. If you continue to proceed on this heavy fossil fuel sort of a binge. And then on the income side, I think Conrad did a decent job in highlighting the opportunities that we are seeing on the flexible income side. And then last but not least, I think, again, with regulation opening up, with other opportunities coming through, we're seeing a lot of assets on the private asset side, mostly bespoke as in bilateral, where companies come to us or we bump into them, and we are able to lend to them on a one-on-one basis at very, very decent yields, very decent businesses doing great stuff. A lot of that, I must confess, has gone into renewables. So you do get quite a lot of demand for funding on that front. It tends to be short duration, which is quite nice because you're not carrying a lot of risk on your book. But for us, that's an area where I think if you are able to fund a lot more assets, it becomes also a nice diversifier, low correlated, and clearly, from a yield pickup point of view, still ticks up that box of inflation plus, which is what the product aims to deliver. Then the last slide, Conrad. Thank you. And then in terms of how we've done, as I said, we've only been on the platform, I think, similar to the income flexible fund around 2020 or so. So you can see, since inception, a little bit behind that target. A lot of that to do with, I think, during this period, we've seen inflation being very, very high, and yet the different asset classes actually struggling to keep up. So hence the product also struggling to keep up with this mandate target. But over the last couple of months or so, especially over the last 12 months, we have seen an acceleration in terms of the product performing better than its target. And then you can see over the shorter term also that continuing to hold, which is, again, not too bad a place to be, given what, if you look at equities have done year to date. I think we're about flat on the domestic side, and then I think a slightly better picture on the bond side. So hence the benefits of diversification actually coming through and being rewarded in the form of, I guess, inflation beating our returns through time. So I'll pause there and and give back to Eugene. Thank you very much.
Patrick, thank you so much for that, and illustrating strong capabilities. I mean, on all levels, SA equity, the enhancements on global equity, and then obviously the fixed income team, Conrad, and the team that comes into play as well. Conrad, if I could maybe just a couple of very quick questions. You mentioned, or you touched briefly on US yields being high at the moment. It's still increasing. What do you make of that? Is the market telling us that we potentially in for a much longer ride on higher rates for far longer than one would have thought?
Yeah, Eugene, and as I highlighted, this is for me a major risk for most asset markets. If the Fed funds rate is going to sit at sort of 5.5% and stay there for a meaningful amount of time, bonds had no business sort of being at 3.5. So they reluctantly made their way back to 4. Now they're at 4.5, because not only is Fed funds rate going to be at 5.5 for a while, but you've also got a mountain of supply and refinancing, and this debt burden is getting somewhat out of control. We've got another US debt stopper at the end of the month here, where if they don't reach a political agreement, the Congress shuts down and the economy, that they can't do any government spending. I think we're normalizing. I don't know if 5 is the level, if 4.5 is the level, but we are simply just back to averages in terms of US yields. So for me, Eugene, the last 10, 15 years was the extreme, not these levels. These levels are normal. For US growth and where US inflation is going to settle over the next few years, which is higher than where we've had it, bond yields of around 4 to 4.5 are quite normal and quite average. So I think markets need to get used to that, asset classes need to get used to that, and it's going to be a reality for us going forward. And what you're seeing now is the repricing and the realization of that, in my view anyway.
Yeah, Conrad, that leads into a question from the audience as well, and it speaks to key event risks. What is now more critical, knowing what they are, or just accepting that they are out there, so you need to remain more cautious? Or how do you deal with that? You can't time these things. So how do you manage that in a portfolio? And Patrick, maybe you can comment on that as well, especially in a balance fund. What are some of those key event risks at the moment, and how do you manage for that?
Yeah, so I would say, the three that are highlighted are almost no longer event risks. They are almost macro realities. We know about them and they're playing out. So rising US bond yields, slowing China, precarious fiscal situation in South Africa. So that's not event risks anymore. Those are just the actual macro backdrop that we're dealing with. Event risks would be, something that's on the radar that hasn't happened but could happen. And so that's re-escalation of Ukraine, Russia. The geopolitical environment is incredibly fluid and fragile at the moment. I think a massive rise in Japanese bond yields. I know that seems like a kind of an off the beaten track sort of view, but this is a massive bond market and drives asset valuations and prices globally, and they are finally letting their bond yields go up. In South Africa, something like a really bad outcome in the general election would be an event risk that's on the radar. And I'm sure there are a few others. So in the portfolio, we kind of try to familiarize ourselves with the potential, try and assign risks or probabilities to them, and when material or meaningful enough, we try and protect. So the way we're protecting at the moment is, lower duration, a slightly higher allocation to ILBs than what we would normally have. None of the real cyclical assets. And, if things calm down and these event risks fade and we have a rally in fixed income asset classes, we'll be on the back foot then. We won't participate. But our view there is that cash giving you 9% is kind of good enough anyway. I saw one of the questions was, what asset class will beat inflation by the most? Well, I think a good place to start is cash. It's going to do inflation plus 4 over the next year with low risk. So, that's offering good value at the moment. So, and Eugene, the last point I'll make before Pat can chip in is just to be tactical. We find ourselves changing positions and asset allocations quite frequently in this market environment versus what we would, traditionally do. So no silver bullet. You come in and you navigate day by day, and you just try and make some logical and probability weighted decisions in portfolios to give you a fighting chance to get through this.
And I mean, on that, it speaks to things like being nimble enough to make those tactical asset allocation calls when you need to. Yeah, Patrick, you wanted to weigh in on that?
Yeah, I think just to add on to Conrad, I mean, I think the challenge with event risks, not only are they very difficult to identify, once you have, you almost, it's there, right? So kind of need to deal with it. So you can't really avoid it. So the best thing to do is one, and I keep beating this drum, make sure that your portfolios are well diversified, right? So don't put all your eggs in one basket. Take risks in areas where there's a semblance of, and I guess a common sense, but conviction. So try not to be too much of a hero in case you miss, and then suddenly you do a lot of damage to the portfolio. And just make sure that your ideas are uncorrelated. So you've got enough ideas that behave differently under different environments, such that if one or two don't work out, hopefully the rest do actually carry through. And then last but not least, to the extent that you feel that the risks are elevated, try and take some insurance. So there are different instruments you can put together. And for example, things like gold, that tends to be a decent diversifier and behaves differently. It's uncorrelated. And then especially the last few months or so, with very, very high inflation coming through and then higher for longer, we have seen actually gold hold its own and actually coming through as a nice diversifier. So a few common sense things to do, but try not to be too much of a hero, especially in this environment. There's just so many things at play that is very difficult to see what is coming and when.
Great to see how all this comes together in your balance fund and your flexible fixed income fund. Gentlemen, we are unfortunately out of time. I can keep you busy for a lot longer. We really would like to get you back on soon in the very near future. Conrad, Patrick, thank you so much for joining us this morning. Very insightful indeed. To our audience, you need any more information on the Aluwani funds, give any of the BCI sales team a call. You'll get the information on the links that we are going to share a little bit later as well with the presentation and the recording. Again, from our side, Patrick, Conrad, thank you so much. Really great to have you with us. Very insightful indeed. Not the time to be a hero, or hand it back to the experts, let them manage it for you. Just a quick reminder to our audience, next week, Wednesday, the 4th of October, we're doing local and global property. We're going to have a fun panel discussion to see where we are heading on those two. Thank you so much. Looking forward to see you in the near future. And stay safe and stay warm for those of you who are out there. Yeah. Thank you.
Thanks, Eugene. Thanks a lot, guys. Cheers.